Hello everyone and welcome back. So today I'm going to show you how to code a trailing stop in Python, and we are going to apply this to a strategy that we have already presented in previous videos and see the outcome of such a method on our equity and our returns. So if this is your first time watching this channel, I would suggest you watch the few previous videos of this playlist, mainly the last 2 or 3 videos where we have described in detail the strategy that we are going to use. And as usual, the Python code is a Jupyter notebook that you can download from the link in the description. This way you can fine-tune your parameters and experiment on your own. Remember, this is an educational channel, so the purpose is not really to build the ultimate trading bot, but rather to demonstrate how things can be done in the algorithmic trading perspective. For the strategy that we are going to use, in brief, we have automated the detection of support and resistance levels, and we will detect the candlestick patterns that are happening around these specific levels. Then we execute our orders according to these signals. For example, at this point, we have a buying signal. It's a bullish engulfing pattern preceded by a strong rejection candle that we can see over here. And according to our strategy, this is a buying signal. So if we execute a buy order at this point, we need to define a stop loss, which usually we are going to fix within a certain distance of pips from our buying price. For example, here we took this distance and we are considering that this distance will be constant throughout our trading procedure. The trailing stop would follow the price as long as it's going in the good direction, which is the direction where we will make profit. So in this example, it's a buying position, the price is going up, and so is the stop loss that will follow the price within a certain distance, but only in one direction. So if the price attempts to go back, the stop loss will remain at its last position. And if the price retraces back and touches the stop loss, our trade will be closed, as you can see here on this example. So we followed the price from this buying position up to this particular position here. Then the price starts retracing back. The stop loss value will remain constant in this case. It doesn't go back, otherwise it's meaningless. We will never reach a point where we can close our trade. So in this case, this one will remain constant, will remain at its last position. The price will retrace back, and when we touch this particular point here, we are going to close our trade. This would allow us to maximize our profits, especially when we have a long price trend. Instead of closing our deal earlier using a take profit value, which would be kind of limiting our profits, we are going to let stop loss trail run through following the price. And this way we can maximize to an extent what we can achieve through long trends. So again, we will apply this example to a strategy that we have detailed previously and previous videos. Therefore, we will use the same program that we have detailed already. If you are not aware of these, you can open the playlist and check the last 2 or 3 videos describing the candlestick patterns and the automation of support and resistance levels detection. The only difference is that we are not going to use a fixed stop loss or a take profit ratio like we have described before, but we will replace these by the trailing stop. And at the end, I'm going to backtest this strategy to show you what kind of returns we could expect from using this trailing stop method. So these are the parts that we have used before. I'm not going to spend so much time on these just to make this video shorter. At first, this is the cell where we are going to load our data. It's the euro versus the US dollar, the daily candlestick charts. And it's going from 2003 up to 2021. Then we are going to use a series of functions to detect the support and resistance levels, and also to detect the engulfing patterns of candles, the shooting stars and rejection patterns of candlesticks. One more time, if you want to know the details, how these are coded, the information is available in the previous videos. Then we are going to generate our signals. If it's a buying signal, I'm going to write 2. If it's a selling signal, we are going to write 1. And if we don't have any signal at a particular candle, we simply keep our signal row equal to 0. And this is our data frame. This is how it's going to look like. We have the opening price, the high, low, and the closing price, the volume, which we are not going to use for this strategy, and the signal column that I have added into my data frame. Then I'm going to use backtesting package to backtest this strategy. This package was introduced in the last video of this playlist. So we need to define a function called signal that would simply return the signal column of the data frame. This is needed for my strategy class. Then we start our backtesting. So from backtesting, I'm going to import strategy. It's a class from the package of backtesting, and the backtest class also. I'm going to import NumPy because we are going to use it here. We need some numerical features from the NumPy package. And I'm going to define my class, which is called myCandleStrategy. It inherits from the strategy class. We are going to override two functions, the initialize function, this one, and the next function as described by the backtesting package documentation. Then I'm going to define a variable, the stop loss trail, which is equal to 500 by 10 exponent minus 4, depending on the precision of the data you have. Here we have a precision of 10 to minus 5, so this is a value that we can experiment on. We can put 600, 650, and so on. I have tried quickly a few different values, and I found good results for 500 by 10 minus 4 distance for the stop loss trail. In the initialize function that we are overriding from this inheriting class, I'm going to define the variable signal1 property of the class that is equal to the function I, which defines an indicator. Here also we are overriding the function indicator of the strategy class. And in this case, my indicator will be the return values of the signal function that we have defined previously, what you can see here. In other words, these are the values of the last column that I have injected in my data frame. So this is the signal that is going to tell me if I should buy or sell a position at this particular row, which means at this particular candlestick, which also means that this is the particular day on which we are going to sell or buy a position. Then we override the next function, which is also executed at each candlestick, meaning every day in our trading history. And I'm going to say that the stop loss trail value is equal to this value that we have defined here for the class. And then for the trade in trades. So if I have open trades, they will all be recorded somewhere in a list of trades. And for each trade in this list of trades, I'm going to do the following. If the trade is long and it has a stop loss, so I have to say that the trade.stop loss, the new value of the stop loss, is going to be equal to this amount. And this amount is equal to the maximum between this part, which is the current trade stop loss, or if the trade didn't have a previously defined stop loss, something called minus np.infinity, meaning minus the infinity. So it's either one of these two values, and the new value of the stop loss, which is the closing value of the candle, of the current candle, minus the stop loss trail distance that I have provided. In other words, this trailing stop loss is going to go only up. It cannot go backwards, since we are always taking the maximum between the old stop loss and the new value of the stop loss. And this is true for the long position. However, for the other positions, meaning the short positions, the short trade positions, we are going to do the opposite. We are going to take the minimum between the old stop loss and the new stop loss value that we are defining here. If you find this kind of awkward, you can find more information on their website, the backtesting.pi. They are on GitHub, and you have a few examples that would help you understand further. But it's going to take some time because you have a lot of information and a lot of classes to read through. Otherwise, if I have a signal that is equal to 2 and the length of my trades is equal to 0, meaning I don't have any open trades at the current state, I'm going to open a new buying position, long trade, with a stop loss value equal to SL1, which is defined right here. This is the closing value of the current candle minus the stop loss trail distance that we have defined here. Same thing if I have a short signal, meaning if self.signal1 equal to 1, and at the same time I don't have any other open trades for the moment, then I'm going to open a new trade, which is a sell position with a certain stop loss that I'm going to define right here using the same method of the stop loss trail. If you don't care if you have an open position or not, I mean, you want to allow to have 2 or 3 or even more open positions in parallel, you could simply remove this. You could simply delete this part. And in this case, every time you have a signal, you are going to open a new trade, regardless whether you have already opened the previous trade or not. So if you have an open trade, you can open a new trade in parallel, or a third one or a fourth one, as long as you have those signals, if you want to squeeze out the maximum trades that you can throughout your trading year. Then we can use the backtest function. We are going to feed it with the data frame of our candlestick values. Then the strategy class, remember, this is the strategy class that I have defined right here. So this is all my strategy here. And we are going to give an initial cash value of $10,000. I reset the commission to 0. I don't want to use commission so far because I would like to know how things are going without any additional parameters. But then, of course, once you tune your strategy, you can add the commission and check how much return you can expect from your algorithm. Then we can run the backtest method, and we store the statistics in something called stat, and I'm going to print this, and this is what we are getting here. So I'm not going to go through all the details here because we have explained these in a previous video. What is more interesting is to check the percentage of returns. So we have 162% of returns with the current parameters that we have used here. We can, of course, try something different. For example, I'm going to remove this one here. I could cut it and put it into comment for the moment, just to increase the number of our trades. I'll run it again and check what we have. So we have around 161. It's almost the same. Actually, it's not changing much. Or maybe you would want to add the trail distance. Let's run it and see the outcome. So we have a decrease. We have 149% of return. Remember, we had 160. Let's try something less than 500. Let's try, for example, 500 and 450. And we have a return of 65%, so it's not worth it. I'm going to go back to 500, which is our best value for the moment. So with 500, we are getting 161% in return. Then we have a maximum drawdown percentage of minus 14%. The maximum drawdown duration, it's 1069 days. So this is very important, actually. When we see the return, this is too good to be true. I mean, 161% over 18 years, it makes around, let's say, 9% per year almost, which is not bad as a return. However, the conditions in which you are trading are not really very nice. Look at it this way. You have to wait for a particular trade, for example, which is the maximum trade duration, 495. So more than a year. You have to leave a trade open more than a year in order to have the outcome. This one can be fixed by decreasing the trailing stop. It means that we have taken a high value of this distance. Or you can go back and fix other parameters in the strategy, in this program, for example. I'll let you fine-tune and experiment on these parameters. It takes a lot of time, so this is the hardest part, actually, to just change parameters and check the outcome and not to get lost in all of these. Anyway, our win rate percentage is 69%, which is amazing. And the best trade percentage is 20%. This is also very nice. So the worst trade percentage is minus 3.8%. This is excellent results here. So our strategy is not that bad, actually, but you need to tune it in order to fit with real trading habits. You can't really open a trade and leave it 2 years in order to get the result. You have to open a trade and close it within, let's say, maximum of 1 month or 2 months, because remember, we are using the daily charts. Now, I'm very curious on trying this same program on an hourly chart or a 4-hour chart, but then we have to retune all of our parameters to fit with this new time scale. And one thing that I didn't have working in the previous video is the plotting function. Actually, I had downloaded and installed an older version of the backtrading library. This is why it didn't work in my previous video. I updated the version And now I have the latest and it seems to be working fine. So this is our equity. We're going from 100 up to 250% here. In fact, it's 262 because we have a return of 161%. You can observe your equity through the years. We can observe the length of this drawdown period here, and it's marked in red. At the same time, we have our profit trades and the loss trades. They are marked in red and green. The size of the trade is reflected in the size of the triangle or the delta symbol. And then we have our candlestick charts that we can observe here. And you have the different trades that we have taken. You can see that we allowed for many trades to be taken at the same time. So since we have more than one signal at this point, this one is the engulfing signal. It's a bearish engulfing signal, so we can sell at this point. This one is also a rejection signal. That is also a selling signal. As you can see, we have different signals resulting in different trades, different orders opened at the same time in parallel. So what I'm going to do is I'm going to test what kind of results we could expect if we can put these in here. So I'm not allowing more than one trade at a time. I'm going to run this, execute it again, and this is what we get. Now we can see that we don't have two or more trades opened at the same time. So we have one trade at a time, which looks more proper and less risky in this case. We could also add one more condition to close our trades, our open trades, in case we encounter an opposite signal. So we can close our trades in two conditions here. Either we meet the stop loss value, the trailing stop loss, or if we encounter an opposite signal. In this case, we can add here if the trade is long, and at the same time, if we have a signal that is equal to 1, which is a selling signal, then I'm going to close the trade. And we can apply the same thing for the other trades. So if we have short trade and the signal is to buy, we are going to close this particular trade. So these two are additional conditions. We're not going to close the trades only by using the stop loss values, but also when we encounter an opposite signal. And this is going to reduce the length of our trades, because as we have seen, some of the trades are too lengthy. We have to wait a year or a year and a half to close some of the trades, and this is not real in the trading life. We have to make it more applicable, and so this is why we have added these two conditions. So if I run this, first of all, I'm going to check the effect on the returns. We have now a return of 228%. This is huge. And then we have a maximum drawdown minus 8.5%, an average drawdown of 1.3%, and the maximum drawdown duration is 2 years. Well, almost 2 years. This is bad. Still we have some points to fine tune here. But look at the win rate. It's 68% of our trades are winning trades. The best trade is 14%. The worst trade is minus 3.7%. And the maximum trade duration now is reduced 176 days. It's better than before. It's still quite long, but it's much better than before. It's not over a year, it's half a year. So we can do with this, we can deal with this. Remember, if we are using daily chart, expect things to be long and slow. If you are impatient and you want things to go a bit faster, you have to go down in the time scale of the candles. Maybe the 4-hour chart is a good idea for algorithmic trading. It's somehow the compromise between slow trading and extremely fast trading, where these types of algorithms don't do much. And the average trade duration is 30 days. It's 1 month. This is perfect. You have your return. We have our return percentage, and we have our average trade duration, and both these parameters are very good. So in other words, the $10,000, the final sum you will get is $32,800, and the peak is $33,000. So it's not very far from our final equity. And graphically, this is what we have. So we don't have those long drawdown durations anymore that we have seen before. We have shorter stuff, so shorter drawdown durations, and our equity looks really appealing from this perspective. And as you can see from this graph, we have more green than red, so the majority of our trading are winning positions. And if we want to take a further look at the candlestick charts, for example, we can see that after the signals, it's all going very well. So we have an opposite signal here. For this short position, we have a buying signal here, so we are closing sell position. Same thing here and here. So here we have a losing trade. This one is a sell position. We have a bearish engulfing candles here. So we sold at this point, but then we have a different signal. So this one was a losing trade. This one is also a losing trade. We have a bullish engulfing pattern with the rejection candle here. So it's a bullish signal. We bought our position here at the opening of this candle, and it seems that the price went down instead of going up. So we closed at some point because of this candle, which has a long rejection tail, and it's announcing a downtrend signal. So anyway, when you have a mixed signals here, it's clear that this part of the market is something that we should stay out of. No trader could guess the future of such a price movement, because look at all of those rejection tails that all of these candles are showing. Somehow we have mixed signals, and it's normal for the algorithm to mess around here, because any trader would have done the same thing. The wisest is to stay out of the market for these periods. So how much this is per year? It's 228 divided by 18. And this is around 12% per year of profit. Remember, we didn't take into account the commissions, the swap costs, and any other fees if you keep your trades opened overnight. Some brokers, they will charge you more when you leave those trades open for a week or more than a week. And as you can see, this is a slow strategy, so it might cost you more than what you think if you are leaving your trades open for a month or so. But anyway, it's a winning strategy. I mean, taking into account resistance, support levels, and the candlestick patterns is something that will definitely give you an advantage over the market. So this is it for this video. I hope you guys liked it. I hope you are finding this information helpful. If so, please support this channel. It's not much, but it really encourages me to continue building those programs and showing you more strategies that you could use in your tradings. And one more thing, most of these ideas are coming from comments that I'm reading and emails I'm receiving from you. Now, I don't have the time, unfortunately, to develop all the ideas at once, but I think we could all benefit from a discussion. So don't shy out from leaving a comment down below. If you are a beginner in the field, also don't hesitate. You can leave a comment. I could show you where to start to learn how to build this type of programs. Thank you for staying that long. Stay tuned for more and see you next time.